Thank you all for coming today. 2 years ago, we gathered here in Sanders during a period of great tumult. Each day brought new lows for the Dow Jones and new highs for anxiety. Several large banks had failed, and we were told that our financial system might be on the brink of collapse and that a widespread meltdown could be imminent. It was hard for us to imagine, and even more difficult to understand, the new vocabulary that had taken over our American vernacular. Derivatives, credit default swaps, mortgage-backed securities, and too big to fail. But fortunately, at Harvard, we had help then, as we do now, to understand how we got where we were and what the future might hold. Today, we intend to take advantage of 2 years' distance to seek some clarity about the causes of the crisis and the path to recovery. The 5 panelists here are not only scholars, they are teachers, and I'm very grateful to them for agreeing to be on this panel today, to share their insights and to inform and instruct us about what they have observed from their varied vantage points. You have been handed index cards as you entered the theater. If you have not already submitted a question online, I urge you to do so in the course of what is to follow, and we'll have some time at the end of the program for your questions. Let me say a bit about the format. After I introduce the panelists, I will pose some initial questions and moderate discussion, and then we'll have time for your questions at the end. This global financial crisis has touched us all, and we are very fortunate to be able to convene and draw upon the members of our community to help us understand what these 2 extraordinary years have meant and what the years ahead might bring. Now let me briefly introduce our panelists. John Campbell is the Morton L. and Carol S. Olshon Professor of Economics and Chairman of the Department of Economics. He has published more than 80 articles on finance and macroeconomics, including fixed income securities, equity valuation, and portfolio choice. In 2006, his outstanding undergraduate teaching was recognized with a Harvard College professorship. He was a member of the Squam Lake Group, a nonpartisan, non-affiliated group of 15 economists who offered guidance on financial regulatory reform in a recently published book, the Squam Lake Report, Fixing the Financial System. Excuse me. Richard Friedman is the Herbert Asherman Chair in Economics at Harvard University. He's currently serving as faculty co-director of the Labor and Work-Life Project at the Harvard Law School. He directs the National Bureau of Economic Research, Sloan Science Engineering Workforce Projects, and he is Senior Research Fellow in Labor Markets at the London School of Economics Center for Economic Performance. He has written extensively on the national and international labor markets. In 2006, he received the Mincer Lifetime Achievement Prize from the Society for Labor Economics. Bridget Madrian is the Aetna Professor of Public Policy and Corporate Management at the Harvard Kennedy School of Government, and she is Director of the Social Science Program at the Radcliffe Institute for Advanced Study. Her current research focuses on household saving and investment behavior. Her work in this area has affected the design of employer-sponsored savings plans in the United States and has influenced pension reform legislation, both in the US and abroad. She is the recipient of the TIAA-CREF Paul Samuelson Award for scholarly research on lifelong financial security. Kenneth Rogoff participated in the first panel 2 years ago, and I thank him for being here for a return engagement. He is the Thomas D. Cabot Professor of Public Policy, an expert in the banking industry and in international economics and finance. He has served as chief economist at the International Monetary Fund and as a visiting scholar at the Bank of Japan, the World Bank, and the Institute for International Economic Studies in Stockholm. He recently co-authored a best-selling book entitled "This Time is Different: 8 Centuries of Financial Folly," based on data covering 66 countries and 800 years. He also holds the life title of International Grandmaster of Chess. David Sharfstein is the Edmund Cogswell Converse Professor of Finance and Banking at the Harvard Business School. His research focuses on banking, financial distress, risk management, corporate investment, and venture capital. Along with his fellow panelist, John Campbell, he is a member of the Squam Lake Working Group on Financial Regulation. This past year, he served as senior advisor to the Secretary of the Treasury and on the staff of the National Economic Council. Please join me in welcoming our panelists. Thank you all so much for being here. Let me start with a question for John. And let's situate ourselves a bit by saying a few words, if you would, about causation. 2 years ago, when we gathered on this stage, our panelists pointed to a number of causes of the crash. They talked about unsound mortgage lending, credit default swaps, over-leverage, deregulation. With the advantage of hindsight, John, how would you nuance this picture of what caused the crash and how it turned into a worldwide crisis? And where do you think we are now? Are we better or worse off than you might have imagined 2 years ago? And what do you see as the biggest challenges ahead? And can you give us any good news? Just had to ask for a little good news at the end, if he can find any.
Well, first of all, I'd like to thank President Faust for organizing this event, assembling the panel, and gathering the Harvard community to talk about the economy. Now, that's not a small question you ask. So I'd like to just start with a brief medical analogy. I think the economy is rather like a person with a chronic, debilitating condition who has an acute crisis, let's say a stroke. The patient is rushed to hospital where emergency treatment is successful. Unfortunately, the crisis and the treatment have complications which make the chronic problems much more serious. Now we have long-standing medical issues that can no longer be ignored and require urgent treatment. The choices are tough, and the doctors are debating how to proceed. Okay, so that's my analogy. What do I really mean? Well, the chronic problems of the economy are going to be familiar in many ways. They include a low household savings rate, pension and healthcare entitlements that will become unaffordable as the population ages, an inefficient tax system, and insufficient investment in public goods such as research and infrastructure. Now, the acute crisis resulted from excessive risk-taking by large financial institutions. They bet heavily that the economy of the mid-2000s would remain stable and that house prices would continue rising, or at least decline only gently. They underestimated the downside risks by relying too heavily on recent experience of benign economic conditions and by failing to understand all the implications of recent financial innovations. Their dangerous complacency was strengthened by their knowledge that in a crisis, if a crisis did occur, the government would be forced to step in to preserve the financial system. Well, who were these risk takers? Some were traditional commercial banks, but many more were institutions that had come to perform traditional banking functions in new ways, the so-called shadow banks. Why didn't financial regulators step in to prevent the buildup of risk before it resulted in a crisis? The main reason is that they lacked the authority to regulate the shadow banking system. But in addition, regulators were concerned primarily with individual institutions rather than the system as a whole. They had little information about the risk exposures of shadow banks, and they were subject to political pressure to keep the mortgage boom rolling along. So where are you now? Where are we now? There is good news. The good news is that the consequences of the crisis could have been much worse. The actions of Hank Paulson, Tim Geithner, and Ben Bernanke averted a complete collapse of the financial system, and in my view were broadly necessary to avoid a repeat of the Great Depression. Since the spring of 2009, the financial system has recovered faster than many observers anticipated, as markets have rebounded and banks have rebuilt their capital. Accordingly, the costs to the taxpayers of the various bailout programs have been lower than was originally feared. The bad news is that recovery in the real economy is too weak. Unemployment, and particularly longer-term unemployment, remain extremely high. This feeds populist anger at incumbent politicians, leading to political paralysis today and uncertainty about policy in the future. And in a vicious circle, this tends to undermine business confidence and further weakens the recovery. The tough challenge we face is to rebalance the economy so that households save more and the government borrows less. But this rebalancing must be gradual to prevent a collapse of economic activity, thoughtful to avoid damaging our prospects for long-run growth, and it requires cooperation from foreign countries that should rebalance their economies in the opposite direction. So I'll finish with one more analogy. The economy is like a bus on a winding mountain road. It needs to turn a corner, but can't do so too quickly or it will tip off the road altogether. And other drivers coming the other way must give us the space we need to make the turn.
That sounds challenging, John. David, let me ask you to elaborate on one part of this. You and John have worked together on the Squam Lake report and focused on regulation. How do you see the issues of deregulation within this mix of concerns and causes that John described? And where do you see us now on the path towards a better regulatory future? How does Dodd-Frank fit with your aspirations for what you think regulation should be? Does it go far enough? Does it go too far? How are we doing on the path to a better regulatory environment?
Well, I think John is right to point out the regulatory failures and for you to raise that question. I think the regulatory failures were there largely because we had a system designed in the early 1900s to deal with traditional banking. The sort of banks that take deposits and make loans. In the last 30 years, we've seen really a revolution in banking. We know that traditional banks are actually inherently unstable without government support. Anytime depositors get worried about the solvency of a bank, they can easily pull their money and run. And so what we saw were banking panics before the government got involved. And in the Great Depression, that was obviously a big problem. And so we developed a regulatory regime to make that traditional banking system more stable. We were operating under that regime really throughout to today. But the banking system's changed a lot in the last 30 years. It's become much more market-based. Banks don't have to hold loans anymore. They can pool those loans. They can make securities based on those loans. They can sell them off. They can be traded. And so what we had was really a market-based system, much more market-based system of finance, and we did not adapt our regulatory system to deal with that new form of banking. And so, John referred to shadow banking. That's what we're really talking about. And it includes many of the firms that got us into the most trouble, like Lehman Brothers, AIG, the credit rating agencies, the money market funds. And that system proved to be unstable in much the same way that traditional banking was unstable before the government created regulations. And so Dodd-Frank is really an attempt, part of it at least, is an attempt and an important first step to creating a new regulatory regime for that new system of finance. It gives regulators authority to make new rules about securitization, to deal with credit rating agencies, to bring into the regulatory umbrella non-bank financial firms that pose systemic risks. So it's an important first step, but it's just a first step, and there are, I think, a lot of challenges going forward. Sort of most fundamentally, the challenge is that there's a constant struggle for the regulators to keep up with innovation. Right? Even if regulators get it right today, there's bound to be new innovation that's outside the existing system that could be destabilizing. And in fact, in some ways, tight regulation of the existing system is what pushes things outside the system. And it was one of the reasons the shadow banking system evolved in the first place. You know, it's sort of like the problem of designing a school playground. You can design a really safe school playground. It's just that no one's really going to want to play there, and they're going to end up on the street corners. And there's no telling what kind of trouble kids can get on the street corners. And that's kind of what we saw. And the challenge is that regulators have to choose the right balance between designing a safe playground and keeping an eye on the street corners. And leading up to the crisis, no one was really looking at the street corners in any kind of real way. We, I think, as economists, have an obligation to be looking more closely at the street corners. I think, at least financial economists, and I include myself, dropped the ball as the system was developing. We weren't paying close attention to that street corners, and we need to understand better the function of this new form of banking. We need to understand the cost and benefits. We need to think about new tools to make sure that it serves a productive function in a healthier financial system. And I think we can't just leave it to regulators to duke it out with Wall Street. So this is Dodd-Frank is a first step, but it's just a first step, and it's an evolving system. I also want to point out that it's not all about shadow banking. There were other problems. There's certainly the crisis developed in large part because there were financial products that were developed that really no one should have been buying in the first place. So, as we think about regulation, Dodd-Frank is one step. It is also important to keep in mind that despite this instability of both traditional banking originally, this new form of banking, that finance plays a really important role in the economy as a way of channeling savings from households to entrepreneurs, many of them in Harvard labs. And without a healthy and stable financial system that is funding those innovations, we don't really have economic growth. So it's an important balance. And it's not over, and the next few years are really going to determine how we strike that right balance.
Thank you. I'm struck by your emphasis on the almost inevitability of innovation pressing against regulation. And Ken, you've written about a certain kind of inevitability over this 800-year period that you looked at. This time is different, written with irony in the very words themselves. Are these crises inevitable? Is there always going to be a financial crisis on the horizon? Was this time different? You wrote your book actually before the world fell apart 2 years ago. What would you add as a kind of appendix to a new edition of this book now?
Well, first, thank you very much, President Faust, and let me echo the comments of John and David of thank you for convening this panel and for the audience to come, and also the privilege of speaking again. I did get to speak here 2 years ago, and I was already drawing very heavily on my work with Carmen Reinhardt, which we'd been then working on for 6 or 7 years already, on compiling data of looking at past financial crises. Frankly, we thought it would happen somewhere. We didn't know it would happen everywhere at the same time. I want to pick up on something David said about, and you did, about it's tough for regulation to keep up with innovation. I think another thing we see fairly universally is complacency build up during a boom. And you get this mentality of this time is different. During this boom, it had to do with we had globalization, better financial policy, everything was going to be great forever. And I think sort of a lot of the economics community probably was guilty of cheerleading this trend in this direction. And crises do happen. They don't happen all the time. In fact, if you run things well, maybe they happen about as often as the frequency of Halley's Comet, but they don't happen a lot less than that either. And if you run things badly, you can have them much more often. Countries like Venezuela have defaulted on their debt every 18 years, roughly. Greece, who's in the news now, has been in default on its sovereign debt every other year since independence. So it certainly matters how you run things, and it's a lot better to have it happen every 80 years than to have it happen every 20 years. One of the things I'm struck by in looking at the data is how similar they are despite different historical circumstances, political systems, institutions, regulations. And I would say in the run-up, although we know less about that because frankly a lot of things are hidden in the run-up, but we see a lot in the aftermath, and the rhythms of the aftermath on housing prices, on the over-leverage, the collapse in indebtedness of the private sector, the surge in indebtedness of the public sector. These are not just qualitatively similar, they're remarkably quantitatively similar. And it, it kind of makes you wonder of what it is. We, in our models, have everyone being self-centered and trying to maximize, but there's something about human behavior that's sort of cutting beneath the institutions that's expressing itself. And financial crises are so striking, they're so big, that it comes to the fore. Let me just conclude with picking up on bad news and good news. Well, bad news, I could go on all day, but one prediction of our book is that, and our related research is that when you have a wave of international banking crises, then very often a few years later you get sovereign debt crises. Debt explodes, it shakes up the system, and we'll see. But I would guess that we may have problems, at least in some of the smaller and medium-sized countries. And in our own country, we're going to have problems figuring out what to do with our exploding debt. The good news, a couple things. First, over the 800 years, every time they've ended. And so it will end. And it's very slow, and it's sometimes painful, and lasts a few years, but they do end. I mean, occasionally, it's not so pretty, I say the ending, but that's a footnote. I'd say a second thing you could be cheered about is you probably hear a lot of negative predictions from economists. It's going to be terrible forever. And the good news is when you start doing 5- and 10-year predictions, we're terrible. I mean, I don't know about 1-year predictions, maybe we're terrible too. But at 5 and 10 years, there's just a lot of things that are difficult to predict. Maybe globalization really will turn out to be pretty good, and technological innovation will help, it'll smooth things out, it'll make things easier. So, I mean, the good news is they do end. It really is kind of tough to predict the long run. And then finally, our policies do matter. I don't want to just take a deterministic view of the world. It's just very different to live in a world where the current undergraduates at Harvard just might not live to see another financial crisis versus one where they'd have one for their 20th reunion and their 40th reunion. So anyway, thank you.
Well, from the very broad and lengthy picture, let's hone in a little bit on some more human dimensions of this. Bridget, your research focuses on household savings and investment behaviors. So how do we think about ways in which ordinary Americans achieve long-term financial security in light of this sluggishness of the economy and uncertainty of markets and the kind of continuing bumpiness that we've just heard described?
So if you looked at the personal savings rate of the U.S. economy for the decade leading up to the financial crisis, it was bumping at around between 1% and 3% of personal disposable income for that last decade. And within a matter of months, it has jumped up to about 6%. So that's a striking increase relative to where it was before the crisis. That's still below longer-term historical standards. So if you look back to, say, the 1950s, the personal savings rate would have been something on the order of 10 or 12% of personal disposable income. And one could ask, why did the savings rate jump up so quickly, and what are the implications, and is it enough, or do we need to do more? I think there are a number of things one could look at in terms of why it's gone up. One is one of the one of the pieces of the financial crisis was a big contraction in the availability of consumer credit. So we simply cut off some of the spending channels that individuals might have used to spend rather than save. A second is, I think a lot of people were justifiably concerned and decided to exercise some precaution and save more. And then the third is that, and I'm not sure whether this is true or not, but some have alleged that our mindset has changed, that we have kind of returned to an older notion of thrift. And looking at the increase in savings, it's kind of a glass half empty, glass half full scenario going forward. The half empty is that one of the reasons that this recovery is dragging out so slowly and is likely to be protracted going forward is in fact because we're saving more. And one of the reasons the economy was growing so quickly leading up to the financial meltdown was the fact that we were not saving, we were spending a lot, but this restraint is now kind of keeping us mired in the recession to some extent. Going forward, I think there's room to be more optimistic, and I think, John pointed out in his remarks that one of the things the crisis had done is it laid bare a lot of underlying problems, one of which was this low savings rate. And, one of the problems of a low savings rate is that when you enter a period of crisis, people don't have a lot of financial resources to draw on. So last December, the country did its very first national survey of financial capabilities to ascertain, well, what is the financial position of U.S. households? And only about half of U.S. households reported that they had a financial reserve of 3 months or more. And that's not a lot to fall back on if the credit card company closes your account or you lose your job or you have a health shock or something like that. And so I think the half full, the good news, since you'd asked for some good news, is that if individuals are saving more, hopefully in the future when these inevitable crises hit, individuals are in a better position to help withstand them. And certainly, government policy is trying to help support increases in the ability of individuals to save in a variety of domains, both in workplace savings programs, which I've studied a lot, and we're having, I think, some success on that margin. But one of the goals of the Dodd-Frank Act with respect to consumer and household finance is to make financial products like savings accounts more accessible, to broaden their reach throughout the economy. So it's not just the wealthy, but all households.
Thank you. Richard, tell us about the jobs part of this, because obviously this is the area where so much attention is now focused. We've been told the recession's been over since June 2009, and yet here we have this persisting unemployment rate. Is this the new normal? How do we look at this going forward? What's likely to happen?
There's been a lag in the pickup of employment to GDP, which is what we used to call the recession, over the last 20-odd years at least. There was a slow pickup of employment in the Clinton period, and we've gotten into the late 90s boom. There was the jobless recovery under Bush, and if you look at the timing, it just gets longer and longer. This one, we'll see how long it goes on, but if it just went normally with the others, you would see it be very long. So I think for the average American, the recovery is going to take an extremely long period of time. And we might not see full employment. This is looking in 5 years or so in the future, which Ken just warned us about. But I would say until the end of this decade. Obviously, there could be some miraculous technical change or something that would happen. But just under the normal process, states are being squeezed, laying people off. The stimulus money gets spent, and we're at 9.6% or whatever it is unemployment. So we are headed for a very, very difficult period. If this becomes normal, and you will see people claiming it's the lazy unemployed who are getting the unemployment benefits. It's that we've already seen things, the workers aren't suitable for the jobs that are there. It will sort of have a certain normality to it, and I think that's going to be a terrible thing for the average person in this country. If it's normal like that, the country really is on a downward trajectory. Let me just make one other comment, because this is a critical time both for the domestic problems we've had that were pointed out, the savings and the aging of the population. We now deal with China, India, and the third world countries competing in the same markets that we do. This is not a time for the country to sort of be economically weak. If we are in this position 10 years from now, I think we will be thought of in the world as a former great country.
Let me pick up on what you just said and pose a question to any one of you, and to use the title of Ken's book as a way to frame it. Instead of thinking about this time is different, how about this place is different? How do we explain the nature of the slow American recovery and the struggles that the United States has had and that Europe seems to have had in comparison with China's very rapid recovery? What's different here, and what are some of the reasons that might factor into that?
Okay, someone else will start.
Richard?
Yeah, I know a little about China, because when the recession hit China, there were these 20 million peasants who were being sent home from the factories making goods for the U.S. And I thought, erroneously, that China was going to be the most harshly hit economy because they were so dependent on trade. International trade picked up. Actually, this is a case where the international economy, I think, was very valuable to the China pickup. The government also put in a stimulus package. When they gave money to the banks in China, they told the banks, and the government has much greater power over decision makers throughout the society, and they said, you loan that money out. And the money got loaned out very, very quickly. And they began a big infrastructure projects, which I think it's maybe easier for them because it's clearer. They got to have roads. They got to have certain things. Some of their projects looks like 1950s U.S. Eisenhower period highways and so on. So they have made an extraordinary recovery. They currently are in a labor market boom. This is what I think the administration hoped the stimulus would do here, and it certainly has not.
So you see the size and efficiency of application of their stimulus, in a sense, as a key differentiating factor.
Yes, and sadly, in a sense, because none of us are in favor of dictatorial government, the power of the government to basically give some orders does, I suppose, work in some crises.
Ken, did you have a thought on that?
I would just add, they weren't at the center of it. We were. I mean, the problem really started out of the United States, Britain, and a few other countries. So I think all the countries that were removed from the center, many of them have recovered much more quickly.
John, did you have any thoughts on that? You were listing causes when you opened up for us.
Well, I think just an observation that the countries that have been worst affected are those that have had the largest financial systems, countries that have specialized in financial services, very obviously Britain, and also those countries that had consumption and housing booms. Countries like Spain and Ireland have been very seriously affected, and the countries that have come out most quickly tend to be the thrifty exporting countries, the Germanys and Chinas. Now, obviously, in the long run, they have problems too if their markets are very depressed. But fundamentally, their task of stimulating domestic consumption is, politically easier than the task that we and some other countries face of rebalancing the economy away from retail, construction, and so forth, and adapting to a less consumption-driven economy. So,
David, you made a comment in your response to my first question about the importance of the financial sector and the importance that it be strong. And John has just pointed out the way that it's weakening in the context of what we've just been through was a key aspect of the challenges that we faced very deeply. 2 years ago, Ken noted that the financial sector was a flagship of the American economy and that it had to come back. What are its prospects? Do you think it will come back more strongly? You added that little plea for the strength of the financial sector in your remark. Was it because you fear that it will not be as strong or that you see impediments to its being as strong?
There was enormous growth in the financial sector, in the last 30 years. I mean, if you look at finance as a share of GDP from 1980 to 2010, it went from more than tripled, like from 3% to let's say about 8%. Some of that was built in, I think, somewhat unhealthy ways. I mean, certainly the credit boom of the mid-2000s was unhealthy. And I think it's important to remember that it wasn't just unhealthy for homeowners and subprime credit and all that, but there was, lending for commercial real estate. There was lending for buyouts that was really not sustainable. And so I think, I have to say another element of it is, and a concern I have about the growth in the financial sector is that some of that increase in the share of finance as a share of GDP is, just built up from a run-up in asset values, and asset managers just get a share of the stock market or the stock market capitalization or the share of those assets. Some of that is good, some of that's unhealthy. And so, again, I think it just goes back to regulation of designing rules that encourage sort of healthy development of the financial sector instead of some of these less healthy parts.
Ken, do you have any thoughts 2 years later about your perceptions then? Would you see the financial sector differently in any way, or you just are reinforced in your perceptions?
I think I made those comments in the context of, well, you can just say, let's shut it down because it caused so much trouble. But I think you have to ask, well, we compete with China, India. What exactly are we going to do? And that's an area where we are very competitive. It's not the only one. There are other high-tech areas, healthcare, where at some ends of it, we're very competitive, but I mean, you don't just want to walk away from it either. I mean, I think as David said, you want to try to prune it and have a better regulatory system. It must be said that we were making a lot of money, and some of the problems got sent out to the rest of the world. And in some sense, the rest of the world has to react to that if we try to go back to business as usual.
Mm-hmm. John, you mentioned, in addition to finance, you talked about housing and the difficulties with housing as being a particularly distinctive aspect of the problems the United States faced. Let's talk about housing a bit. Have we gotten to a place where the government is going to be playing an appropriate role in housing? Have we addressed the issues that led to the subprime difficulties? Where are we in relationship to housing in the future?
Okay, well, let me take a crack at that.
Thank you.
I think, there's been a long-standing goal of public policy in this country to promote home ownership. And there are good arguments for that up to a point, that, people who own their own homes have more of a stake in their community and so forth. I think we went too far, frankly, in pushing that social goal. I think for people with lower and less stable incomes, a home can become a ball and chain, and it's simply you're less flexible if you own a home than if you rent, and this can be a problem. In addition, if home ownership goes wrong and turns into foreclosure, there's a lot of evidence that can damage neighborhoods. So a foreclosure isn't just damaging for the person who loses their home and for the bank that loses a lot of money. It's also damaging for the neighborhood and house prices get depressed in a whole neighborhood. This is something I've done some research on. So I think there is a public interest in home ownership, but you mustn't push it too far. There is a public interest also in having stable forms of mortgages. And in fact, if you look back at the Great Depression, part of the problem in the Depression was that there were very short-term mortgages that had to be refinanced very frequently. When the Great Depression hit, huge numbers of people were unable to refinance and lost their homes, and that seriously contributed to the depth of the Depression. So coming out of that, the US policy promoted long-term, fixed-rate, nominal mortgages. The 30-year amortizing mortgage is something that is really hardly known in the rest of the world. It's a US invention which was a response to the Great Depression. So I think we do want to try to structure mortgages in a stable way. And some of the innovations in mortgage forms, you know, apparently clever adjustable rate mortgages that became very common in the boom, are simply unhealthy for the same reasons that the Depression-era mortgages were unhealthy. The problem is that institutions that were originally set up by the government to promote long-term, stable mortgages really got out of control and became institutions too big to fail. And I'm referring to Fannie Mae and Freddie Mac, which I think were allowed to get out of control and contribute to the problem. They really became a part of the shadow banking system. And unfortunately, we have not yet confronted this problem. We need to figure out a way for the government to promote the right kinds of mortgages without doing it by creating institutions that themselves contribute to financial instability. And this is unfinished business. Dodd-Frank has really not confronted this issue.
When we think about families and what they're worried about, housing and foreclosures has obviously been a big issue. Another major issue for many families is retirement, as retirement savings evaporated in the crash, and people worry about what security there is in the future, especially with labor markets of the kind that Richard just described. People are losing jobs at fairly advanced ages and then looking at a long period of unemployment before what would have been retirement. How should we be thinking about retirement in this context, and what might have changed about our approach to it?
Well, I think one of the things the economic crisis has illustrated for at least older households is the value of the social safety net programs that we have. So in the 1930s, during the Great Depression, many of the elderly were thrown into poverty, and that was the impetus for creating Social Security. And Social Security is not, it would not be wise to rely on Social Security as your sole source of income in retirement, but I think it served its purpose as a social safety net during the recession. And benefits were not cut. They might have not increased very much. And the news this week, retirees going forward aren't going to be getting a Social Security increase for next year. But the benefits haven't fallen. And it has turned out to be a useful mechanism for some older workers who've been laid off from their jobs because they were able to claim Social Security benefits maybe a little bit earlier than they had been planning, which does have some long-term ramifications, but it's been a kind of a useful complement to the unemployment insurance system. I think the big question going forward is what happens to this program when it runs out of money, because the level of promised benefits that we have made, and this is true of both Social Security and of Medicare, exceeds the tax revenue that we are collecting to pay for those benefits on a sustainable basis. So the latest trustees report put out by the Social Security Administration in August predicts that Social Security is going to run out of money in about 2040. Medicare is predicted to run out of money about 10 years sooner than that. And the question is, what happens? Interestingly, the Social Security Administration is constrained by law to pay benefits out of its current resources. No one knows exactly what that means, but the presumption is that either taxes have to go up or benefits will have to be cut by about 25%. And that would be a substantial shock to older households going forward. And one of the earlier panelists had mentioned one of the kind of things going up to financial crises is a sense of complacency. People aren't really watching what's going on. And I think one of the problems right now is nobody wants to bite the bullet and try and solve these problems early, because the solutions aren't going to make anyone happy from a political standpoint. It's either raise taxes today. If you raise them today, you'd have to raise the payroll tax by about 2%. If you wait until 2040, you'll have to raise it by 4 to 5%. Reduce benefits. The benefit cut, if you wait till 2040, would have to be about 25%. Or you can make people retire later. The U.S. has done that. We've increased the normal retirement age. We could increase it further. There was an interesting story in today's Wall Street Journal about the protests that several countries in Europe have gotten from recent initiatives to increase the retirement age there. And workers in France are evidently planning a protest to increases in the retirement age recently announced in France. But we have to somehow find the political will to address those issues sooner, because if we wait, the problem just becomes worse and worse.
How does all of this fit with the much debated issue, and perhaps some of you disagree with others of you, about the size of our deficit and how we think about the national deficit? There are a lot of challenges on that question about complacency. We're not paying attention. Challenges on the other side. This is not the moment to be attending to it. We should worry about that later once we've re-stimulated the economy. How do you see that issue playing into what you were just describing, Bridget, in terms of complacency and also federal programs and long-term federal funding? Or how do any of you see it in terms of the issues you've been raising?
This is John's question of the bus making the right turn. And I think maybe somebody else can I don't propose a question to other people. If we get into a double-dip recession, which is a reasonable possibility, of maybe less than 50% probably, but if we did, the deficit will go up. And so if we don't have a solid recovery, we're not getting out of the deficit, and that's the fear of cutting a deficit too quickly. Mm-hmm. Luckily, the Brits are going to do that. They're going to do the experiment, and we'll have a pretty good sense, because they're trying to cut their deficit. Although they may also see some French-type protests when really people find out the nature of what's going to be happening in the UK. So there, if we just sit tight for a while, we'll have a little advance warning, at least of a country very similar to ours, that also has the banking crisis, at what point you may push yourself into a double dip. Mm-hmm.
We're a very rich country, and there does tend to be this sense of complacency where we have American exceptionalism, and the Chinese will lend us money forever, and everyone will want the dollar forever. And these things can go on for a long time, but as my thesis advisor, the late Rudy Dornbush, said, these things, these unsustainable financial trends go on longer than you think, and when they end harder than you think. And I think it's just wrong to not worry about the deficit growing. And I agree completely with Richard. I mean, there's basically nothing you can do quickly. You shouldn't do anything quickly. But it's also something at 5 and 10 years that's absolutely on the horizon. I think there's no way of avoiding that eventually something has to give. Taxes have to go up, spending has to go down, some combination of the two. And Americans have really not had to think about that for a very, very long time. We're faced with a crisis. We either cut taxes or raise spending. Well, it's not like that in most of the world, and we've had this run. But at some point, it'll end. Our debt, our combined consolidated government debt, is, again, referring to my work with Carmen Reinhart, just about at the all-time high where it was in World War II, and it's soaring. Maybe it can go on forever. We don't know. I think nobody knows. But it's a very tough tightrope. We're in a slow growth. I could get worse. I don't know. But it's probably slow growth for a long time. Deficits soaring. At what point, do you adjust? A very tough call.
I completely agree with the theme that we have to try to address the problem before a crisis hits. I mean, it's very hard to do that in our political system. I think the system is, good at responding to crises when it's forced to respond, but it's not so good at getting ahead of problems. One aspect of this is that interest rates remain extremely low. The government's borrowing costs are very low. Problems can develop when investors start to lose confidence and interest rates go up, because then it's just much harder to keep up with your debt when you're having to pay a high interest rate on it. This is what Greece discovered earlier this year. And, for the moment, rates are so low that it postpones the problem. Japan has also benefited from extremely low rates over the past 20 years, and that's one of the things that has enabled them to postpone putting off adjustment for a very long time. I think what I would like to see is, instead of a British-style immediate austerity program, measures that are going to take effect further out, but that will build confidence. Now, the problem is you can't just say, oh, we will be doing things that will address the deficit in 5 years, because, that's not credible. You have to show that you can take some pain today, but measures like raising the retirement age, perhaps with advance warning, but legislating now, that could build confidence. And there are other measures of that sort that would begin to address the problem. But again, our political system just has great difficulty dealing with this.
Thank you. I was just brought a little pile of questions from all of you, so let me pose some of those to our panelists. How strong is the evidence that the various bailouts or stimulus programs are working or are not working? For example, TARP, American Recovery and Reinvestment Act, GM, et cetera. Who would like to take that? David, would you take that one?
Yeah, I think TARP for sure, and the associated alphabet soup of programs that the Federal Reserve and Treasury put together, I think have worked for what they were intended, which was to stabilize the financial system, and at much lower cost to the taxpayer than was originally envisioned. And so I think that that goal of stabilizing the financial system, I think it was really a home run. GM's going to cost less than people thought it was going to do. Even the bailout of AIG is going to cost less than what was anticipated. Stimulus is hard to measure because we don't see the alternative. I mean, there are some estimates out there that suggest that if we hadn't had stimulus, then unemployment would be even higher than it is today. Of course, there's this countervailing effect that's going on right now, where the stimulus spending is rolling back. A lot of that went to help state and local governments, and now you see the state and local governments without the stimulus money having to scale back. So on net, we're kind of like running out of stimulus, and maybe why we're seeing some increase in unemployment. But I think in terms of stabilizing the financial system, I think that these programs worked out really quite well.
Here's another. As the federal government continues to print money wantonly to deal with budget shortfalls, what trajectory do you foresee for the dollar, and how will it shape the relationship between the federal government and the Federal Reserve?
Well, I've worked on empirical exchange rates all my life, and one thing I can say with great confidence is it's almost impossible to predict I think it is very hard to say. Lately, the euro dollar's been who's weaker, who's more messed up. The United States is winning right now. Europe was winning earlier in the year. I think it's tough to say. Certainly, there is a lot of uncertainty hanging over what's going to happen to inflation in the United States. Good chance we won't have any, maybe even deflation, and yet at the same time, the Federal Reserve is responding very aggressively, experimentally, with these things that we can look at in our classroom in theoretical models, but in practice we don't really understand. They've just been so little used. We could end up that the cat gets out of the bag and it's a lot worse than we thought. Nobody knows.
Thank you. There has been a big increase in income inequality over the last 2 decades. Do you think that played a role in the financial problems? Are collapses more likely when there is large inequality, or are the two things unrelated? Richard, maybe we'll give that one to you.
I've actually done some looking at that of late, and preceding a lot of these banking crises, and the IMF has a list of 120, I think 4 banking crises. Preceding a lot of them is a big run-up of inequality. And so I do think there's some connection. Then the interesting or hard part is the extent to which it's inequality driven by huge risk-taking rewards at the top versus the inequality that normal citizens find they can't buy the products that they would buy, and they go into consumer debt beyond what they rationally should. I don't think anyone knows that, but I would put some stress at what's gone on at the top, and when we talk about the size of the banking and finance sector, it has to be a reformed sector in which people don't make huge sums of money for taking what turned out to be unconscionable risks and devious behavior, the liar's loans that you probably heard about 2 years ago. I think inequality does play a part, and the bad news is that the inequalities after most of these crises, it isn't that it comes back to a lower level. We were on a rising trajectory. It's gotten worse during this recession, and I don't see any particular forces to pull it back.
Ken, did your many crises have any thing to reveal about the relationship of inequality to financial crises?
We didn't look at it as much as Richard has, so that's interest. I mean, you have asset bubbles, and it's not surprising that the wealth's held unequally. So if prices of stocks and housing are exploding, you're probably having income inequality. And David mentioned that the asset managers get a piece of that, so it certainly wouldn't be surprising. But I don't know if it's a driving force or just a manifestation.
Here's a question I find intriguing. What do you think is the most effective thing that has been done for the economy in this administration? What do you think is most vital for turning the United States into a relatively debt-free nation once again? Those are 2 quite different questions, but either one or both, if anyone would take it on. If there's something effective. David, you've been down there. What's the most effective thing that got accomplished?
Well, I think I said before that, I think stabilizing the financial system is important. I think the area where we need to do better is, we do still have a housing crisis that, Bridget mentioned earlier. People before were using their home equity as a credit card, and the consequence of that was huge consumption growth related to basically drawing down on that credit card. We no longer have that. And so somehow we need to deal with that problem. We have a lot of borrowers that are well underwater. And this is not answering the question of what's most effective. It's sort of saying, what's the challenge? We've got a lot of underwater borrowers whose consumption is really impeded by that fact, and somehow we need a way to deal with that. We have mechanisms when companies get over-indebted to eliminate that debt. If you're if you own commercial real estate, there are ways to getting out from under that. It's a little bit harder the homeowner. And somehow I think we need a deal with a system that's going to deal with consumer debt and reduce that such that the economy can grow again.
We're still benefiting from works progress construction projects. With our infrastructure in such bad shape, would not something similar be a good investment at the moment? Is it time for another WPA?
Well, I mean, the low interest rates and with the shadow price of labor basically zero, a lot of unemployed people, if we had a set of good projects to pull out, and it's maybe because of the lack of forward thinking, we don't really have these plans set up, I think that would be a great time. Our bridges are always being rated as, I don't know, D or by the civil engineers group. Of course, that creates work for civil engineers, but I don't think they're inventing that. And one part of the administration recovery package that I think has been more forward-looking and done with infrastructure, there's been a lot of ARA money that's gone to research and development. And we'd been on a declining government spending on federal research relative to GDP over the last, I don't know, 10 or 15 years. And there was a big burst, and there was bipartisan support for this. And that money actually got spent surprisingly fast because basically the researchers who got the grants from NIH, NSF, and so on were told spend the money very quickly, and it got spent on graduate students and postdocs. But that money is also running out, and we could see a turnaround there. But that was a forward-looking expenditure in intellectual infrastructure.
For which we at Harvard and other universities are extremely grateful. Just a couple more questions. Let me do two more. Over the past 2 years, the global recovery has mostly been led by emerging markets. Is it possible to envision a sustained global expansion without the United States and Europe recovering from current levels, and with emerging markets leading on both production and consumption levels?
We're experiencing it, so it's certainly possible to imagine. I guess it's a big difference if the US and Europe are growing slowly versus they're sinking quickly. I mean, if the US and Europe go into recession, the emerging markets will get hammered just like they did in this crisis. But I mean, before, emerging markets were growing much faster, and now it's even a little more so. But I think it's really just an exacerbation of a trend we've had going on for a long time.
Mm-hmm. You'd agree? Let me end by asking you all to, or whoever would like to comment on John's analogy about the bus, which somehow I see as a double-decker bus, so that it's a little bit tippy, going around these difficult mountain roads. If we think about that image, one of the aspects of it is that we are decision makers driving the bus, or somebody is a decision maker driving the bus, so that there is agency that can be exerted, though it has to be done with tremendous good judgment. And it assumes that a certain amount of experience will play out. If there's a good driver, that should help. How do you all see, others of you see this analogy? Do you think that the possibility of agency and decision-making really will have a huge role here? Do you think that there are just forces that are so unpredictable that it's like the driver driving in the dark without headlights? Or how would you see us in relationship to John's depiction of what the future looks like?
I think maybe it's a little bit like saying we've got a people who have a lot of experience driving cars, and now we've put them behind the steering wheel of a double-decker bus. We don't have major financial crises every other day, and so we don't have, the great wealth of experience in figuring out how to deal with them. When we understand some basic principles, if you turn the steering wheel this way, the bus will go this way, but maybe we don't know, quite how quickly or things like that. And there was a lot of debate a couple of years ago about the size of the stimulus package, and there were a lot of concerns that it was too big and we were going to end up generating inflation. And with the benefit of hindsight, those concerns seem a little bit foolish. But I think we really didn't know at the time.
So it's an uncharted road in a sense. We don't have a very good map, and the skills may not apply. Richard?
Yeah, because I think there's several problems there. One is the information system that the government has, or to make decisions, systemic things that John referred to. They don't have very good information. We're in an internet era where we get information all the time, and we are still relying largely on old-fashioned surveys to get our data. So they're often responding to information that's going to get GDP figures. They revise them quarterly. Sometimes they revise them quite a bit. So your driver doesn't have such good information. And then two, I think the question of who does the driving is important. And we sort of trusted the Wall Street types to do the driving. I think that was where finance was considered the crown jewel of our economic system. And that clearly failed. And it's unclear to me who should be doing the driving next round. I would hate to see the same group back doing the driving, because they've shown that they go whizzing around those roads and they crashed us. But I don't like have a list of people or groups who I'd say I would prefer economists perhaps to some others. But other than that, it is a big, I think you put your finger on a really important issue.
So we've concluded economists should drive the bus, and there should be more funding for research to help us get out.
But Ken, let me say,
Am I a shill for the university?
but Ken, at the very beginning of our discussion, you, and I think someone else as well, raised some questions about economists being perhaps too trusting that everything was just going to continue to grow. So let me just end by asking if any of you would comment on how will it be different next time for you as economists? How are you different because of this in the way you think about economics? And what could economists do or ask or challenge or study that would have an effect on preventing us from having such experiences again?
Yeah, well, a couple of thoughts on that. I mean, certainly the economics profession did not do a great job of understanding what was happening quickly enough to provide effective warnings. And I think there are two problems, and I would hope that as academic economists we could address them. One problem is over-specialization. So we were really, I'm probably throwing out too many analogies today, but the blind man and the elephant. A lot of people had specialties and could see a piece of it. We had housing experts who were concerned about the housing market. We had experts in banking who were concerned about other pieces of this. There were people thinking about global imbalances. But it was very hard to put it together. And so one of the things that was that I found so wonderful about this Squam Lake group and the experience of writing that report was coming together with people of different specialties and trying to put together what we knew. And I would love to see us continue with that. The second point is just that academia is slow moving. We get data with a lag, and then we spend a couple of years studying it, and then the journal takes 3 years to publish it. And, we have great papers coming out about the aftermath of the technology bubble. They're being published right now. And they're very good and very insightful and informative, but it's a bit late. And we need to speed up. Now, there are institutions that do that. The IMF is one such organization, and I think it's no coincidence that many of the most insightful people on the crisis, including Ken, had the experience of working at the IMF. But it would be good if we could find other ways for academics to operate more quickly.
Other reflections on this,
I
David?
hesitate to make this comment having fairly recently been on a windy road in Europe and having gotten into an accident. But I'll say it anyway, which is I think that academic economists in particular, I personally learned a tremendous amount from engaging in real policy debate. And I think there needs to be, many economists are engaged with that. I think less so in my part of the world in finance, where there has been a kind of neglect of understanding the financial system. And so I think actually more engagement with the actual difficult problems of policy instead of, we sometimes narrow the problem so much so that we can actually get something published. And policy is messy, and when you engage with it, it opens up whole new avenues for thinking about broader questions that you then can go back and do the research on. But that engagement policy, and frankly the engagement with Wall Street and understanding what's going on is very important, both because we have a lot, I think, to add to that, and because I think it enriches our research.
Well, thank you. I don't know if we'll be here 2 years from now asking what we've learned in the 2 years just ahead of us, but I think you all have given us some great lessons about how to think about universities and what they do and the place of economics and all of you within them. So thank you very, very much. Please thank our panelists.